Everything you know about money was learned in a world that no longer exists. The investing rules you follow, learned in that world. The mortgage advice your parents gave you, built for that world. The financial strategies your bank recommends, designed for that world. That world ended a few years ago, and almost nobody noticed. Not because it crashed, not because of one crisis or one event, but because the invisible force that made everything work, the single condition that powered 40 years of rising stocks, affordable mortgages, cheap goods, and expanding wealth, quietly reversed. And what is coming next will not look like anything the last 4 decades prepared you for. This is not a prediction, this is not speculation. The shift has already happened. The question is whether you understand it in time to adjust.
To understand where we are going, you need to understand where we have been. Cast your mind back to 1981. America was in crisis. Inflation was running at nearly 14%. The price of everything was rising so fast that ordinary people were genuinely terrified about the future of money itself. The Federal Reserve's response was dramatic. Interest rates were raised to nearly 20%. 20%! Think about what that means. A mortgage at 20%, a business loan at 20%. Borrowing money cost a fortune. It was painful, brutally painful. It caused a deep recession. But it worked. Inflation was crushed. And then, something remarkable happened. From 1981 onward, interest rates began a long, slow, almost uninterrupted decline. For 40 years. All the way from nearly 20% down to essentially zero by 2021. 40 years of falling rates. That single fact, more than any policy, any technology, any leader, shaped the entire financial world that you and I grew up in. It made mortgages progressively cheaper. It made borrowing easier. It pushed investors into stocks because bonds paid almost nothing. It inflated the value of every asset that could be bought with cheap debt. Houses, equities, real estate, private companies. It made the rich significantly richer. It made debt feel almost free. And it created a generation of investors, homeowners, pension managers, and financial advisors who built their entire understanding of how money works around one invisible assumption: that rates would always stay low.
Let me explain what falling interest rates actually do, using a simple image. Imagine the economy is a plant. Interest rates are the temperature of the room. In a warm room, the plant grows fast. Borrowing is cheap. Companies expand. People take mortgages. Investors buy assets. Growth accelerates. In a cold room, the plant slows down. Borrowing is expensive. Companies cut back. People delay purchases. Investors become cautious. From 1981 to 2021, the room got progressively warmer every single year. Not dramatically, not all at once, just steadily, consistently, reliably warmer. And in that warm room, 3 other things happened simultaneously that supercharged the effect. First, globalization. China joined the World Trade Organization in 2001. Hundreds of millions of low-wage workers entered the global labor market almost overnight. The cost of manufacturing everything, clothing, electronics, furniture, machinery, collapsed. Cheap goods flooded Western markets. Inflation stayed low. Central banks could keep rates low without triggering price rises. The warm room stayed warm. Second, demographics. The baby boomer generation, the largest in history, was in its peak productive years. Huge workforce, strong consumer spending, tax revenues rising. Governments could borrow cheaply because the economic fundamentals looked strong. Third, technology. The computing and internet revolution drove productivity higher, more output with fewer workers. Again, low inflation. Again, rates could stay low. These 3 forces, globalization, demographics, and technology, combined with falling rates to create the longest bull market in modern financial history. Stocks went up, bonds went up, property went up, pension funds grew, university endowments swelled, sovereign wealth funds expanded. The formula seemed permanent. Borrow cheap, invest in assets, watch everything rise. It worked so consistently for so long that an entire financial industry, banks, advisors, pension managers, fund managers, built its models, its products, and its advice around the assumption that this environment was normal. It was not normal. It was a 40-year anomaly, and it ended.
The break did not happen on a single day, but if you had to pick a moment, it was somewhere between 2020 and 2022. Four things reversed almost simultaneously. The first reversal, inflation came back. The pandemic disrupted global supply chains on a scale not seen since World War II. Governments injected trillions of dollars in stimulus directly into economies. Demand surged. Supply could not keep up. Prices rose, then kept rising. Inflation hit levels not seen since the early 1980s across the United States, Europe, and much of the developed world. The assumption that inflation was permanently tamed? Gone. The second reversal, demographics turned. The baby boomers stopped working and started retiring in their millions every year. The enormous productive workforce that kept wages manageable for decades began shrinking. Labor became scarce. Wages rose, not because of generosity, but because of simple supply and demand. Fewer workers, same demand, higher wages, higher costs, higher prices. The demographic tailwind that powered 40 years of low inflation became a headwind overnight. The third reversal, deglobalization, began. The U.S.-China relationship, the partnership that made cheap manufacturing possible, began fracturing. Trade wars, technology bans, supply chain security concerns, political rivalry. Companies that spent 30 years moving manufacturing to the cheapest possible location began moving it back, or to friendlier countries. Reshoring is more expensive than offshoring. The deflationary force of cheap Chinese labor reversing. The fourth reversal, debt became expensive. To fight inflation, central banks raised interest rates faster than at any point in modern history. The 40-year decline ended. Rates went up sharply. Suddenly, the formula that powered everything, borrow cheap, invest in assets, watch everything rise, stopped working. Mortgages became expensive. Corporate borrowing became expensive. Government debt became expensive to service. The room that had been warming for 40 years started cooling, and almost nobody in the financial world had a plan for a cold room, because nobody under 60 had ever really worked in one.
What does this new era actually mean for your money? It means that the assets that performed best in the old era, long-duration bonds, high-growth technology stocks, heavily leveraged property, face sustained headwinds in the new one. It means that the pension funds, insurance companies, and investment portfolios built on 40-year-old assumptions are quietly being stress-tested in ways their managers did not model for. It means that governments carrying enormous debt loads, debt that was manageable when rates were near zero, now face rapidly rising interest payments that crowd out spending on everything else. The United States government is now spending more on debt interest than on its entire defense budget. Think about that. It means that the housing ladder that previous generations climbed, powered by falling rates making each rung cheaper than the last, no longer works the same way. Rates are not falling to make your next mortgage cheaper than your last. They may not fall significantly for a very long time. It means that the simple investment advice that worked for 40 years, put money in a diversified portfolio of stocks and bonds and wait, faces a genuinely different environment. Not impossible, not hopeless, but different. And different requires different thinking.
Here's the most important thing to understand. This is not a cycle. Cycles go up and down and return to where they started. What we are describing is a paradigm shift. The underlying conditions that created the last 40 years, cheap labor, integrated global supply chains, a massive and growing workforce, central banks with room to cut rates, those conditions are not coming back in their old form. The next 20 years will be shaped by different forces: structurally higher inflation, structurally higher interest rates, slower growth, more expensive debt, more volatile markets, governments under greater fiscal pressure than at any point since World War II. That does not mean catastrophe. Every era creates its own opportunities, its own winners, its own strategies that work. But those strategies are different from the ones that worked before. The investors, homeowners, businesses, and governments that adapt to the new conditions early will navigate it. The ones that keep waiting for the old world to come back will not. The old world is not coming back.
So here's the question I want to leave you with. If the financial rules of the last 40 years were built for a world that no longer exists, what rule are you still following that you need to rethink right now? Drop your answer in the comments and share this with someone whose financial plan was built entirely in the old era. Because the first step to navigating a new world is admitting the old one is gone. Subscribe. New video every week.